All right, let's dive right into this explainer. Today, we're taking Harmonic Inc. and putting it through the ultimate valuation gauntlet. We're going to apply the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some rigorous discounted cash flow modeling to see if this company is a hidden gem or a value trap.
Here's the roadmap for today. We'll start with a quick snapshot of Harmonic, then evaluate it through our 4 institutional-grade valuation lenses, and finally, synthesize it all into a definitive verdict.
So, moving right into Section 1, the Harmonic Inc. Company Snapshot. Let's establish the vital stats of our test subject.
Let's lay down the basics. Harmonic, trading under the ticker HLIT, is currently sitting at right around $9.91 a share, giving it a market cap of $1.64 billion. Now, at first glance, you might think, okay, it's just another standard mid-cap tech equipment provider. But honestly, underneath the surface, this company is in the middle of a massive structural pivot, and it's looking like the broader market might actually be completely mispricing it.
Check this out. They are literally shedding their old legacy video business, selling it off to MediaKind for $145 million in cold hard cash. Why? Because they want to transform into a pure-play broadband innovator. In that new broadband segment, it is absolutely on fire. We're talking about an 87% year-over-year explosion in their backlog and deferred revenue, which now sits at an incredibly massive $582.1 million.
Okay, on to Section 2, the Warren Buffett lens. We're looking for that economic moat and an owner-oriented management team.
So how would the Oracle of Omaha look at this? Well, passing Harmonic through Buffett's objective criteria, we hit some incredibly strong signals. First up, that moat. They hold an unbelievable 98% market share in Virtual CMTS. That's cable modem termination systems. 98%. That is virtually a monopoly in that specific niche. Their debt is totally manageable too, with about $109 million in cash practically offsetting roughly $111 million in total debt. And as for an honest, shareholder-friendly management team, they just bought back $43 million in stock in the first quarter alone. Buffett loves to see that.
And here's the real kicker for Buffett, what he calls owner earnings. Harmonic's just printed $30 million of free cash flow in Q1. If you annualize that out, you've got a business generating real, tangible cash. For Buffett, when you combine a moat like that with strong cash generation and apply a standard margin of safety, this stock looks like a very strong candidate, especially at any price dipping under $12.
Moving right along to Section 3, the Peter Lynch lens. Lynch loves growth, but he demands it at a reasonable price.
Lynch famously loves to categorize his stocks into distinct types, and right now, Harmonic is the textbook definition of a fast grower that's emerging from a turnaround phase. This growth is being completely driven by a huge 43% year-over-year surge in their core broadband revenue. But you know what's even more impressive? Their rest of market sales grew by an insane 78%. That means they aren't just growing, they are successfully diversifying away from their oldest legacy customers. Now let's calculate Lynch's absolute favorite metric, the PEG ratio. That's price to earnings divided by the growth rate. If we take a forward PE of roughly 24.7, which is based on their midpoint guidance of about 40 cents EPS, and divide that by that massive 43% broadband growth rate, the result is a PEG ratio of 0.57. For Peter Lynch, anything under a 1.0 is considered a screaming buy signal. The growth you are getting completely outpaces the premium you're paying for the stock.
All right, on to Section 4, the Benjamin Graham lens. Will Harmonic survive the father of value investing?
This is the ultimate stress test. Graham's checklist is notoriously ruthless. It makes a bank auditor look relaxed. Now, Harmonic does pass on adequate size and strong finances, but its earnings stability during this big pivot is a bit mixed. And here's where they hit a total wall. It lacks a dividend, which is an immediate fail for a defensive Graham investor. Plus, the price-to-book ratio is hovering right around 3.0, basically double what Graham prefers. Simply put, for a pure asset play value investor, Harmonic just looks way too expensive.
And the math entirely backs that up. If we explicitly plug their roughly 40-cent projected EPS and their $3.22 book value per share into Graham's famous intrinsic value formula, the square root of 22.5 times EPS times book value, we get an intrinsic value of just $5.38, meaning at the current price of $9.91, there is absolutely zero margin of safety here. For Ben Graham, this is a clear avoid or sell.
Let's move into Section 5, DCF and alternative valuations. Let's step away from the guru philosophies for a second and just dive into the cold, hard math.
Taking that really impressive $30 million of Q1 free cash flow and assuming a $120 million annualized base, we can build out our discounted cash flow model. If we model a fairly conservative 15% growth rate over the next 5 years, along with a standard 2% terminal growth rate, and discounted it back at a 10% weighted average cost of capital, our base case fair value calculation lands at roughly $13.50 a share.
And if we look at a sensitivity matrix to test those assumptions, you can really see the upside. Even when we tweak our cost of capital from 8% to 12% and adjust our terminal growth slightly, the valuation ranges from $10.80 on the pessimistic side up to $17.20 on the optimistic side. Notice something there. Even our most pessimistic bounce suggests the stock is currently undervalued at its $9.91 price tag.
To cross-check this, we can run 2 more alternative models. A reverse DCF tells us that the current $9.91 share price implies the market is expecting a truly dismal 3% future growth rate from Harmonic. Just 3%. That seems incredibly low given their actual 43% broadband growth. Additionally, a sum-of-the-parts model reminds us to tack on that impending $145 million cash injection from the video business sale straight to their asset base, significantly boosting their intrinsic value.
Finally, Section 6, Synthesis and Final Verdict. We've got some conflicting signals here, so let's pull it all together.
Looking at our master synthesis table side by side, the narrative actually becomes pretty clear. The Peter Lynch framework screams strong buy based on that incredible 0.57 PEG ratio. Warren Buffett sees a 98% market share moat and aggressive buybacks signaling a buy. Our DCF model also points to a clear buy. It is literally only the notoriously strict asset-heavy Benjamin Graham framework that flags a sell. But before we stamp a final call on this, we must weigh the realities of the business. The strengths are undeniable, right? Explosive 43% broadband growth, a massive $582 million backlog, and a super cash-rich balance sheet augmented by that $145 million divestiture. But there's a key risk that is very stark: heavy customer concentration. Just 2 customers currently make up 58% of their broadband revenue. If either of those top 2 operators pull back, this whole growth story takes a major hit.
Blending all these insights impartially, the final verdict leans heavily toward a buy at $9.91. The sheer explosive momentum of this broadband transition, validated by both the DCF and Lynch frameworks, heavily outweighs the legacy, conservative valuation hurdles set by Graham. This is a classic growth at a reasonable price setup.
Which leaves us with a rather provocative thought to end on today. Harmonic is currently right in the middle of a major structural pivot. But if they are generating $30 million of free cash in a single quarter while still finalizing this transition, how explosive will their valuation become when that massive $582 million backlog is finally realized as top-line revenue? I'll let you do the math on that one. Thanks for joining me on this explainer.